So imagine a company with this massive billion-dollar hole in its balance sheet.
Right. Just steadily bleeding foot traffic in these aging brick-and-mortar shopping malls.
Exactly. Now imagine that same company's stock suddenly jumping, like nearly 8% in a single afternoon.
All because they announced a partnership to sell, what was it, marshmallow-scented candles?
Yeah, literally keeps. So when you see a major retail stock plummeting like that, only to suddenly surge on this kind of unexpected, quirky news, you have to ask yourself.
Are you looking at a rare, undervalued bargain?
Or are you staring straight into a brilliantly disguised value trap? Today, we are focusing our lens on Bath& Body Works, Inc. They trade under the ticker symbol BBWI.
And we're looking at a very specific snapshot in time here, right?
Yeah.
April 17, 2026.
Yes, exactly. We've gathered a huge stack of sources for this deep dive. We've got raw corporate financial statements, technical analysis charts, analyst ratings, and a really deep pool of market sentiment data.
Which is great.
Yeah. The mission today is to look under the hood, cut through the algorithmic noise of the stock market, and figure out what underlying mechanics are really driving this company's valuation.
Before we start tearing into those financial mechanics, though, it is vital to establish the parameters for today's discussion.
Oh, absolutely.
We're going to build the strongest possible bull and bear cases for this company based strictly on the data provided in our source stack. But, this deep dive is an educational exploration of market behavior and corporate finance.
Right. We are here to dissect how the market interprets data. None of this constitutes financial advice.
Exactly. Just an educational look at the numbers.
So we're entirely focused on unpacking the why and the how behind the numbers. Let's start at the surface level.
Yeah.
Because the immediate price action is where all the dramatic headlines are currently being written.
Yeah, the daily charts have been wild.
As of our April 17th snapshot, the stock is quoted at $19.46. That is a sharp, sudden increase of almost 8% from a recent floor of $18.04.
Right, but to really understand that jump, you have to look at the broader canvas. Zooming out to the 52-week range, this is a stock that has traded as high as $34.66.
Oh, wow.
And as low as $14.28. So at roughly $19 and change, carrying a market capitalization of about $3.63 billion, it is hovering dangerously close to its annual floor.
Which makes the news catalyst driving this bounce so fascinating, I think. The sources attribute this April 2026 rally to two specific announcements.
The Amazon store and the Peeps, right?
Yeah. The launch of a new Amazon storefront and surprising new product partnerships with Vera Bradley and Peeps, as in, the bright yellow marshmallow candies.
Yeah, it's definitely a choice.
I really have to push back on the market's reaction here, though. I mean, a Peeps partnership and a digital storefront caused a near 8% jump for a $3 billion company.
It sounds a bit much.
It feels completely disproportionate. Is this just a sugar rush for the stock, or is there a real sustainable turnaround here?
Your intuition there is spot on. You're touching on a really crucial behavioral mechanic in modern trading. It's the difference between novelty-driven liquidity and structural turnaround.
Okay, unpack that a bit.
Well, markets, especially retail trading algorithms, are programmed to buy novelty. Headlines containing Amazon or a quirky cultural brand like Peeps, they generate immediate social media mentions.
Right, it trends on Twitter or whatever.
Exactly. That creates an influx of short-term buying pressure. But if you look at the 200-day moving average, which is currently sitting way up at $24.15, you see a completely different, much darker story.
I want to break down that 200-day moving average for a second, because it's more than just a line on a chart, right?
Oh, absolutely.
If the stock is at $19.46 and the 200-day average is over $24, that essentially means the average investor who bought into this company over the last 6 or 7 months is holding a losing position.
That is the psychological weight of a long-term downtrend. Every time the stock experiences one of these sudden 8% spikes driven by novelty news, those trapped buyers see an opportunity.
To sell and get out?
Exactly, to sell and just break even. That creates a massive invisible ceiling of selling pressure. So a single Amazon storefront does not instantly erase the structural downward gravity created by months of institutional selling.
So if the market is just using this marshmallow news to potentially exit their losing positions, that tells me we need to stop looking at the headlines and start looking at the actual cash engine of the business.
We'll do it.
Let's open up the income statement for the fiscal year ending January 2026. We need to see what is actually funding these operations.
This is the point in the data where the narrative really splinters, because the numbers present a massive corporate paradox.
Yeah, they really do. Top-line revenue for the fiscal year came in at $7.29 billion. If we compare that to 2025, which was $7.31 billion, we're looking at a slight decline.
Right. It's not a catastrophic collapse, but the growth engine is clearly stalled.
Definitely. However, net income, the actual profit after expenses, was a solid $649 million. That gives them a diluted earnings per share, or EPS, of $3.11.
Which is pretty healthy.
Yeah, and let me clarify that diluted part for a second because it matters. That metric assumes every single convertible bond or executive stock option is exercised into shares.
Basically showing us the worst-case scenario for how thin the profit pie could be sliced.
Exactly. And even
Yeah.
with that dilution, $3.11 per share is substantial.
It is substantial, and it's backed by actual tangible cash. The cash flow statement is arguably the strongest piece of paper in their entire financial stack.
It's impressive.
Very. Their cash from operations is incredibly robust at $1.1 billion. Free cash flow from the previous fiscal year sits at $660 million.
Yeah.
Yeah, for a legacy retail brand, generating that kind of liquidity is a major defensive moat.
But then you cross-reference that cash generation with the balance sheet, and
Yeah.
suddenly the defensive moat looks more like a sinkhole.
Yeah, the balance sheet is rough.
Total assets sit at $5.07 billion, but their total liabilities are a staggering $6.35 billion.
Ouch.
Right. When you subtract the two, you are left with negative shareholder equity of $1.28 billion.
Negative $1.28 billion. That's heavy.
They do have $953 million in cash equivalents on hand, but overall, the company owes significantly more than it owns. I mean, it's like an upside-down mortgage on a house.
That's a great way to put it.
I'm trying to visualize how a corporation operates under that. It's almost like a financial straitjacket. Is that an immediate red flag for investors?
The straitjacket analogy is highly accurate. When a company has negative shareholder equity, they are functionally trapped by their own capital structure.
Because of the debt.
Yes, they're generating plenty of cash to pay their monthly operating bills, but they lack the balance sheet flexibility to take on cheap debt for, massive innovations or acquisitions. They're forced to maintain the status quo.
But how are they generating so much cash if their revenue is shrinking and they're trapped by debt?
By executing ruthless operational efficiency, this is the detail in the sources that shouldn't be ignored. Despite the heavy liabilities and declining sales, they are maintaining an 8.9% profit margin.
That's actually incredible.
It really is.
Yeah.
In a brick-and-mortar retail environment that is currently hostile to discretionary spending, holding a near 9% margin means management is aggressively cutting costs.
Optimizing the supply chain, that kind of thing.
Exactly. Optimizing supply chains, likely quietly closing underperforming store locations. They are squeezing every possible dime out of a shrinking customer base.
And management's own outlook confirms that squeeze, right? They issued very conservative, cautious revenue guidance for the upcoming quarters.
They know top-line growth is going to be incredibly difficult to find.
So if we have a company with great margins and strong cash, but shrinking sales and a billion-dollar hole in its equity, how are the trading algorithms interpreting that contradiction?
Let's move into the technical analysis and market sentiment data, because that paints a very specific picture.
Right. And spoiler alert, the technical indicators do not care about the 8.9% profit margin.
No, they do not. They only care about price action and momentum, and currently the algorithms are universally bearish.
The sources show a flashing strong sell signal across almost every moving average, from the short-term 5-day all the way up to that 200-day average we discussed earlier.
Right. And the 14-day relative strength index, the RSI, is sitting in a neutral to weak zone.
But the MACD is what catches my eye. It tracks the relationship between two different moving averages of the stock's price, and it is showing clear downward momentum.
Yet, to unpack the MACD further, it is essentially measuring the speed of the stock's decline.
Okay.
When the short-term moving average crosses below the long-term moving average, it signals to institutional momentum traders that the downward velocity is accelerating.
And the algorithms just react to that.
Exactly. They see that mathematical crossover and automatically initiate sell orders.
And that mathematical selling pressure is boxing the stock into a very tight corner. The data shows immediate support. The historical floor, where buyers usually step in to catch the falling knife, is between $17.30 and $17.60.
But overhead resistance, the ceiling where those trapped buyers we talked about start selling to break even, is looming just above at the 50-day simple moving average of $20.67.
Being squeezed between a $17 floor and a $20 ceiling creates a real pressure cooker for traders. And if you look at the professional analyst ratings, nobody knows which way the pressure will break.
No, the consensus rating is a hold.
Right. Barclays maintained an equal weight rating with a $25 price target back in March 2026. But the broader range of analyst targets is wildly fractured.
Fractured is an understatement. You have worst-case scenario targets down at $15.
Praise.
You have an average cluster around $27.62. And then you have some incredibly optimistic bull targets stretching all the way up to $56.
When professional analysts looking at the exact same balance sheet come up with a $40 difference in their valuation, it tells me the traditional models are breaking down.
The models break down because the professional community cannot agree on whether the debt will crush the cash flow, or the cash flow will eventually pay down the debt.
That's the million-dollar question.
But while the analysts are debating, the options market is making its true intentions known. And this is perhaps the most critical data point in the entire sentiment stack.
Yes, the put options. We have to talk about this. The data shows highly significant volume in put options sitting exactly at that $17.50 to $18 support level.
Right.
A put option, for those listening, gives the buyer the right to sell the stock at that specific price. It's basically an insurance policy against a crash. But if retail investors were the ones buying the stock today because they saw the peak piece headline, who is buying all these put options? The smart money, institutional players, hedge funds, and sophisticated algorithmic traders. And this dynamic explains exactly why retail traders constantly get trapped in these scenarios.
Okay, walk me through the mechanics of that trap, because you hear about retail traders getting wiped out by this, and it seems almost predatory.
It is entirely structural. So
Yeah.
imagine an institutional fund holding millions of shares of the stock, watching the revenue slowly decline. They want to sell. But if they dump millions of shares on a random Tuesday, they will crash the price and destroy their own portfolio value.
Right, there wouldn't be enough buyers.
Exactly. They need a massive surge of buyers. They need liquidity to absorb their sell orders.
So they need an event, a catalyst.
They need a headline about an Amazon storefront or a marshmallow candy partnership. Retail traders see the headline on social media, see the 8% price jump, and suffer from FOMO.
Fear of missing out.
Right. They assume the stock is bottomed out. As retail rushes in to buy at $19 or $20, the institutions quietly sell their heavy bags directly to those retail traders.
Wow.
And simultaneously, those same institutions buy massive amounts of put options at $17.50.
Okay, I see the sequence now. They are hedging their bets, they sell their shares into the retail buying frenzy, and they buy put options just in case the entire floor collapses.
Exactly.
When the novelty of the news wears off a week later, the buying volume vanishes. The stock drifts back down toward that $17 support level.
And the institutions are protected by their options.
While the retail trader who bought at the top of the news spike is now holding a depreciating asset.
That is the anatomy of a liquidity trap. And it brings us to the most vital question of this analysis.
Which is?
Looking beyond the short-term trading games, we have to determine the true fundamental nature of this asset. Based on the paradox of high cash flow and massive debt, is BBWI an undervalued gem or the ultimate value trap?
Let's look at the actual valuation multiple to try and answer that. Currently, the stock is trading at a forward price to earnings, or PE ratio, of about 6.9x.
Which is incredibly low.
Yeah, historically, this specific stock has averaged a PE closer to 16x. For context, a 6.9x PE implies that if the company paid out 100% of its earnings to you, it would take less than 7 years to earn back your initial investment.
Right.
By traditional Wall Street metrics, that is dirt cheap.
It is exceptionally cheap. But we have to define the difference between a stock that is simply mispriced and a true value trap.
Okay, what's the difference?
A value trap is a company that screens as cheap by every traditional metric, like a single-digit PE ratio, but deserves that low valuation because its underlying business model is facing irreversible structural decay.
Give me an analogy.
It's like buying a massive, beautiful commercial building at a 90% discount, only to discover the city just permanently rerouted the main highway away from it.
Oh, that's brutal. So let's build the two opposing arguments, starting with the bull case. The argument that the highway is not being rerouted, and this is an undervalued gem.
The bulls point directly to shareholder rewards.
Right. The company pays a very strong 4.4% dividend yield. They are engaging in aggressive stock buyback programs, which artificially reduces the number of shares and boosts the value of the remaining ones.
And they have that resilient 8.9% profit margin we talked about.
Exactly. The bull argument is that if the Amazon storefront can digitally replace the foot traffic they are losing in physical malls, that 6.9x PE is the entry point of a lifetime.
The bear case, however, focuses entirely on structural decay and that upside-down balance sheet. The bears emphasize a metric known as the debt-to-EBITDA ratio.
Let's unpack EBITDA, because that R at the end is doing a lot of heavy lifting for a retail stock. It stands for earnings before interest, taxes, depreciation, amortization, and rent.
Right?
Why do analysts pull rent out of the earnings equation? Oh, right, because for a legacy brick-and-mortar retailer, mall leases are their most massive fixed operational cost.
Exactly. By stripping rent out, analysts can compare the core operating health of a physical store directly against a pure e-commerce competitor.
That makes total sense. And when you factor the massive debt load against their earnings before rent, the leverage ratio is alarming.
It is. But the bears argue the true structural decay isn't even financial. It's demographic.
A Gen Z problem.
Yes. The bears believe this brand is fundamentally struggling to attract Gen Z shoppers. If you are a lifestyle brand and you fail to capture the emerging generation of consumers, your long-term revenue goes into terminal decline.
Here's where it gets really interesting to me. That demographic threat makes the company's financial strategy seem wildly contradictory.
How so?
Well, if they're facing an existential threat from an aging customer base and they have a $6.35 billion liability anchor around their neck, why in the world are they spending their cash on a 4.4% dividend and stock buybacks?
It does seem counterintuitive.
Right. Why wouldn't they take every single dollar of that $1.1 billion in operating cash and aggressively pay down their debt or, I don't know, invest it in massive digital transformation?
It is a deliberate and somewhat cynical corporate strategy often seen in legacy companies transitioning into maturity.
Yeah.
Management realizes that massive organic top-line growth is likely behind them.
Okay.
If they stop paying the dividend or halt buybacks, the traditional value investors who currently hold the stock will immediately sell, crashing the price.
So the dividend is basically a ransom payment to keep current investors from abandoning ship.
It functions that way, yes. They use their impressive operational cash flow to manufacture shareholder value through financial engineering like buybacks and dividends, rather than structural business growth.
Wow.
It's a strategy that can sustain a stock price for years, provided the cash flow remains stable. But if that demographic shift accelerates and mall traffic completely collapses, the cash flow will eventually fail to cover both the dividend and the debt servicing.
And the debt always takes priority.
Always.
Synthesizing all of this data, the algorithmic threats, the negative equity, the strong cash flow, and the demographic challenges. What is the actual outlook here? How do we map these contradictions onto a timeline?
You really have to bifurcate your timeline into two distinct realities. In the short term, over the next few weeks, the volatility offers a playground for tactical traders.
So short-term strength.
Potentially. If the superficial momentum from the novelty brand partnerships holds, there is technical room for the stock to rally and test that $20.67 resistance ceiling. Traders will definitely attempt to ride that algorithmic wave.
And the long-term reality.
The long-term gravity is incredibly heavy. To permanently break a multi-month downtrend and escape the value trap classification, a company must demonstrate more than optimized cost-cutting and quirky merchandising.
They need real growth.
Exactly. They have to prove to institutional investors that they can reverse the decline in actual sales, and they need a viable pathway to deleverage that upside-down balance sheet.
Right.
Until the market sees a structural reduction in debt and organic adoption by younger demographics, that 6.9x PE ratio is not a discount tag. It's a warning label.
It's a profound lesson in why isolating a single metric, whether it's an 8% daily jump or a massive dividend yield, is incredibly dangerous without understanding the underlying machinery.
Absolutely.
Before we close, I want to clearly reiterate that everything we have dissected today was a pure analysis of the provided corporate data, technical indicators, and market sentiment. We are mapping the battlefield of the stock market, but we are not providing financial advice.
The goal is to equip you with the specific mechanisms to look beyond the financial headlines. When you see an anomaly on a stock chart, you now have the tools to investigate the liquidity traps and capital structures hiding beneath it.
And I want to leave you with one final thought to mull over, building on the demographic threat we uncovered in the bear case.
The generational divide.
Yes. If a legacy retail brand's truest existential crisis is an aging core demographic and a structural failure to resonate with the next generation of consumers, does launching a secondary storefront on Amazon and selling Marshmallow branded lotions actually bridge that generational divide?
Or is it just a temporary Band-Aid on a much deeper wound?
Exactly. Are those moves just highly visible algorithmic bait designed to distract from a business model that is quietly aging out of relevance? It is definitely something to think about the next time you walk past an increasingly quiet shopping mall.